This is still a very fragile, very fast-moving dynamic, and I don't think anybody really knows the ultimate end game here. Is this a pause for time before future retaliation? Is this actually genuinely sustainable? So from our perspective, this is just yet another element of uncertainty that markets are having to deal with. Now, I think markets actually have dealt with things quite rationally over the course of this year, where we've had to digest a huge amount of information. Again, though, from our side, we would much rather focus in on fundamentals, the fact that earnings revisions today are in a much more achievable place. So we could and should expect to see more earnings beats across the region. That, for us, is a big positive. We see significant tailwinds. We're still positive on the fact that this long-awaited rotation in China from being an investment-led economy to a more consumption-led economy will occur. I think a lot of the discussion that we've seen around trade has probably delayed that, whilst China is evaluating how much precedence it needs to put on self-sufficiency versus that rotation. But it will happen, and once you manage to then free up the, 300 million or so low-income migrant workers in China from a consumption perspective, that is a lot of money. And that changes the dynamic once again.
No, fair enough. And there's also this other rotation. This is linked to the dollar. If you do see, as I think most people do, to be fair, it going back to getting softer as de-dollarization continues, right? Foreign money is going to be looking at this and going, look, things are looking better for the U.S. They're probably less likely to go into a recession now, but it's still not great. And more to the point, the rest of the world, including Asia, is looking better.
Yes, correct. No, we would agree with that. And I think the key here is on a relative basis. We've come from a very difficult place, particularly in Asia, particularly in China. And so, yes.
So let me, let's talk a little bit more about your space, discretionary equities, right? You're saying that fundamentally, bottom up, you've been able to find literally gems, right? Companies that despite 3 wars, despite the tariffs war, somehow still manage to not just do business, right, but to do it very well and to keep earnings and as well as cash flow going. What are the common, have you been able to sort of pick out common threads, or does it really depend on different business models? I mean, it's not just about, look, I've got my, I've got my hand firmly on my supply chain. It's got to be more than that, right?
I think it's more the latter. We've got to take a very customized, very bespoke approach to the way we look at each individual company. And I come back to the point I made a little bit earlier. The bulk of our focus is on those earnings revisions, trying to identify companies that, in an ideal world, are at that point of inflection where they're moving from earnings downgrades through to earnings upgrades. Now, the drivers behind that can be multiple and incredibly varied, but having a team on the ground here in Asia with a very firm understanding of the underlying businesses they're covering, we think stands us in very good stead.
So optimistic on the E in the PE, right? Are you looking for Asia to re-rate then?
I think if we come back to what we were talking about a little bit earlier around the potential for future rate cuts, particularly across Southeast Asia, I think we should expect a re-rating. Economies are in reasonable shape. So yes, I think we could see a situation where both the E and the P are delivering relatively well for us.
All right, so let's go up to 30,000 feet in the macro, and President Donald Trump, right, who is under pressure, right, to be able to present to the public and his people wins, right, out of this Iran-Israel crisis. You could probably tick the box there. Okay, it looks like it's a win for now. NATO, he's hoping for a win in The Hague, right, if he gets the European nations to increase defense spending up to 5%, right? What about the big one, though? U.S.-China. What is your thinking there? Before, I don't know, before the 90 days expires, will we see something done between both sides?
I mean, clearly we've seen a little bit of movement. We were sort of over in London beginning of this month. We saw a little bit of acceptance that China's role in the global trade ecosystem is potentially larger than many people, I don't think expected, but realized at the time. At the same time, China has done a very good job of diversifying its export revenue. Today, less than 3% of revenues coming from the US. A meaningful pickup, even in the last 3 or 4 months, of trade with ASEAN, with Europe, with LATAM. So definitely taking steps to reduce the reliance on the US, which to a certain degree, puts them in a better position in terms of those discussions.
Yeah.
If we take it all back to its absolute basics, what is this whole conversation about? And I think at the moment, we're all trying to understand what the end objective here from a US trade policy is. But if we strip it back to its absolute sort of nuts and bolts, it's trying to get the US to consume less and Asia, China to consume more.
Yeah.
And so that comes back to the piece I was talking about a little bit earlier in this rotation that China itself has been very vocal in talking about to try and use reform to push through greater consumption. Now, you could argue that was happening independently of the US piece, but at the same time, I think those two are probably relatively favorable.
And maybe fortunately for China right now, they've got sort of their secret weapon right now is DeepSeek. It may end up, creating jobs and stimulating consumption. Who knows? All right.
Yeah, no, I think China has done a great job in terms of cost-effective productivity of tech, and I think that again is something that was perhaps missed by many global investors.
Okay. All right, Mick.